Hey everybody, Smart Silver Stacker here. The US economy is a ticking time bomb, and we need to talk about that, especially in the context of what we saw yesterday when a higher than expected US CPI, the inflation print, triggered a massive sell-off in markets, and perhaps more importantly, a big sell-off in gold and silver. Now, I just wanted to take a quick look at the long-term chart of gold to start things off today, because I had a few people leave some comments on yesterday's live stream saying, well, what happened to the long-term chart formation, the cup and handle? Well, you know, I don't talk about this on every video, but I mean, this is still in effect. You can see a very bullish pattern on the gold long-term chart here, a cup and handle pattern. Yesterday's sell-off really didn't have anything to do with this. It was just a little bit of noise. I mean, it wasn't even that big of a sell-off. Gold was down something like less than 2%, silver down a little more. It was more that, there was this huge, sharp sell-off on that inflation data. But I want to talk today about why that sell-off has been a massive overreaction. I expect it to be fairly short-lived, and why the Fed is going to have to print huge sums of money in the very near future, and there's multiple reasons why. So first of all, take a look at the price action from today. I mean, gold and silver already recovering a bit, silver up a little over 1%, gold also up marginally, but still, the sell-off didn't continue today. Gold showing some pretty solid strength there at the $2,000 level. If you want to buy the dip that we've had, check out SD Bullion. It's my channel sponsor. It's where I buy gold and silver. Right now, they've got 10-ounce silver bars still 89 cents over spot. Looks like that's ending today at 5 p.m. So if you want to get some cheap physical silver on the sell-off, check them out. Now, first of all, let's just discuss why we had that sell-off, really across markets yesterday on the release of that inflation data. So the inflation data came out hotter than expected. Surprise, surprise. I don't think anybody who watches this channel would actually be surprised by that, because we know inflation is likely a phenomenon which is going to continue. It's going to get worse, and it's actually already a lot worse than the official numbers are telling us. But I want to examine this. This is the chart of the 10-year U.S. Treasury yield. And look at what happened yesterday on that news. Everybody got this idea, hey, the Fed's going to be tighter. They're going to have less incentive to cut rates. Inflation's still high. And really, the only thing that happened was that people think maybe there's going to be a rate cut coming in June instead of in March. But that's not really going to matter, and you have to just look at this. The 10-year yield spiking following that print. Think about what is occurring in the banking system right now. You have regional banks who are still sitting on a pile of low-yielding U.S. Treasuries on which they have billions and billions of dollars of unrealized losses. If they are forced to sell those treasuries at a loss, it's going to be pandemonium in the market. And every time the U.S. 10-year treasury yield, or the U.S. treasury yield in general across the yield curve, increases, these banks' losses get much bigger. And that is one reason why the Fed is going to have to get into markets and print. But there's several other reasons. This is just probably the smallest thing, even though it's massive and it represents a huge risk to our financial system. Let's take a look at this. This is a report we got a couple days ago from the Mortgage Bankers Association titled 20% of commercial and multifamily mortgage balances mature in 2024. And as you can see here, according to the Mortgage Bankers Association, 20%, that's $929 billion of the $4.7 trillion of outstanding commercial mortgages are going to mature this year. That's a trend which has been increasing. It's up 28% from the amount that matured last year. And one thing that's been happening here, you can see in this report, they point out that many loans that were set to mature in 2023 were extended or otherwise modified. So they've been kicking the can down the road on these maturities. But now they've reached the end of that road, and nearly $1 trillion of this debt is going to mature this year. Why is that a problem? Well, the problem is that as the Fed has hiked rates, the real value of these properties is diminishing significantly. There's not as many buyers. The valuations for these $4.7 trillion worth of properties were built up during a time when we had near zero interest rates, so financing was readily available. It created this huge amount of money to chase these properties and drive up the value. Well, now the loans that are backed up by these properties, the value of the property, the collateral, has diminished to the point where it can't actually back up the loans. So if the banks are forced to repossess the properties, they're going to accrue a massive loss because, what good does it do a bank if you've got a loan out for $1 billion against a property? Or, I'm not a real estate guy. I don't even know if that's a realistic figure, but the property's only worth $500 million. The borrower defaults and you get this $500 million property. Well, now you just took a huge haircut. And that's the problem that we're facing here. The Fed is going to have to cut rates. They're going to have to stimulate demand for these properties by creating the opportunity for buyers to finance at low interest rates so they can go in and drive the price of these properties back up to bail out the banking system. Also, it's important to note that the extensions and modifications that have been going on, the can kicking down the road, they've been trying to extend how long they have to refinance these things because they know there's going to be a huge problem. It has increased the number of loans reaching maturity this year from $659 billion to $929 billion. So there's a huge, flock about to come home to roost, so to speak, in terms of the valuation of these commercial properties. Do you think the Fed is going to keep rates high and allow the banking system to collapse? No, they're not. They're going to get out. They're going to print huge amounts of money. And, when they do, I think it's going to shock people just how much they actually end up having to print. Sorry, I have this screen here not quite centered, but yeah, this is a huge problem for the banking system. So keep an eye out for problems to develop, new crises to develop. We've already seen this happen with New York Community Bank Corp, whose shares sold off massively last week on their announcement of losses from their commercial real estate portfolio. There's much more of this to come until the Fed begins easing. How about this? $10 trillion in U.S. Treasuries coming to the market in 2024. So here's another reason that the Fed is absolutely going to have to get into the market and cut rates, probably buy up some of that debt. You have $8.9 trillion of government debt maturing over the next year. On top of that, you have a budget deficit around $1.4 trillion. That's according to a projection by the Congressional Budget Office, which we're going to talk about some more of their forecasts, which, I'm going to show you something in a little bit that's going to be kind of shocking. Let me get through this. And then the thing I'm going to show you about the U.S. national debt is really kind of a shocking number. And it's much worse than we're being told. And I'm going to show you why in just a moment. But think about this. You've got U.S. debt maturing, $8.9 trillion, over $1 trillion of additional borrowing. That's $10 trillion that needs to be borrowed this year. The higher the Fed keeps interest rate, the higher the interest on that debt is going to be for the federal government. And keep in mind that this is from Bloomberg. It was just in November that the interest on the national debt exceeded $1 trillion per year. And that number is going to continue to increase until the Fed cuts rates. Or they get in and buy a bunch of this debt to drive down the interest rates. Of course, that's debt monetization, that's QE, that's going to be massively inflationary. But, we saw yesterday, inflation isn't going anywhere. And regardless of how high it gets, rates, there is no option here. And, when this becomes apparent to markets who are obviously still clueless, when you look at the reaction yesterday, I think the flight into hard assets, gold and silver, and especially physical gold and silver is going to be massive. You're going to see premiums skyrocket. I had somebody leave a comment yesterday, said, Smart Silver Stacker, silver's below $22. Every other asset class in the world has gained. And you're not entirely wrong. I don't think you can say every asset class, but the vast majority of assets have exceeded the performance of the metals. Even gold, even though it's near an all-time high, hasn't really kept pace with, tech stocks, all these Bitcoin, which is surging, ETF inflows going into Bitcoin, huge amounts of capital flowing into these more speculative assets. And yet silver and gold quite unloved. Yeah, well, that's true. I mean, you're not wrong, but it's very hard to find value in markets these days, I will say. For me, it's kind of hard to buy AMD when their PE ratio is like 300. I mean, are they really going to be able to grow earnings that much with AI? I'd rather buy something cheap, personally. It's just me. Maybe it's the contrarian in me, but I like to buy things when they're cheap. So yeah, silver's incredibly cheap right now. You're not wrong about that, but that's going to change when investors realize what's going on with the U.S. economy. I mean, look, the fact that a lot of people are buying what the mainstream media tells them right now is an advantage for stackers. We can get real money, gold and silver, at a discount. It's not financial advice, just, what you can do right now. This is the average monthly interest rate on U.S. debt. You can see it's been moving up ever since the Fed began their program of rate hikes, and it is going to continue moving up. We're paying $1 trillion in interest right now. The average interest rate, only 3.15%. Fed funds rate is over 5. U.S. Treasury, a 10-year U.S. Treasury is yielding over 4%. Short-term treasuries are yielding even more than that, some of them over 5%. So, this number, as more and more of this U.S. debt is rolled over, we're talking about $10 trillion in 2024 that's going to be borrowed. You're going to see this move up, and you're going to see the interest on the national debt skyrocket, unless the Fed gets in here and cuts rate and buys treasuries and drives yields down. So I think that's what you're going to see. I mean, there's only so much interest that they can pay before this becomes the biggest item on the national budget. Already at $1 trillion, it's the third biggest. It's exceeding national defense now, but soon it will exceed Medicare and Social Security as well. And well, that's a Rubicon that once you cross that, I don't think there's any coming back, unless, of course, the Fed gets in there and buys up the debt. Of course, when you have debt at the levels we have, the only way to really pay it back is in devalued currency, and that's what we're going to see. Now, here's the bit about the CBO that I wanted to get into, because this is the really shocking, scary part here. This is their report titled The Budget and Economic Outlook 2024 to 2034. This was recently published by the Congressional Budget Office. And I just want to read this paragraph to you, their projections at a glance. The deficit totals $1.6 trillion in fiscal year 2024, grows to $1.8 trillion in 2025, returns to $1.6 trillion by 2027. Thereafter, deficits steadily mount, reaching $2.6 trillion in 2034. Measured in relation to GDP, the deficit amounts to 5.6% in 2024. Now, we're not talking about the debt. We're talking about the deficit to GDP ratio here. Grows to 6.1% in 2025 and then shrinks to 5.2% in 2027 and 2028. Now, I know this is maybe a little dry, but trust me, I'm going to show you something here in just a moment that puts all of this into a very alarming context. I mean, as if this isn't alarming enough. After 2028, deficits climb as a percentage of GDP, returning to 6.1% in 2034. Okay. Since the Great Depression, deficits have exceeded that level only during and shortly after World War II, the 2007-2009 financial crisis, and the coronavirus pandemic. So, these were emergency bouts of spending where the deficits soared, but that is soon going to become the just, regular way we do business here. But look at this, okay? That's the forecast by the CBO. I want to show you another forecast from the CBO from 10 years ago. This is a copy of a report titled Debt and Deficits in CBO's Updated Budget Outlook 2014 to 2024. This was published in 2014. And there's just one real specific paragraph here I want to draw your attention to give you an idea of how accurate the CBO's forecasts are and how they tend to skew the data. So 10 years ago, the CBO said our current debt level of $11.9 trillion is expected to reach $12.7 trillion by the end of 2014, after which debt will grow by an average annual rate of 4%. CBO projects that debt will exceed $18.6 trillion by 2024, which translates to a 46% increase in the debt in just a decade. So in 2014, they were saying by 2024, we're going to have $18.6 trillion in debt. Well, how much do we have? Oh, 34.2 trillion. So it turned out that the debt grew a little bit faster than the CBO was forecasting. So, if you look at today's forecasts in context of the CBO's forecast from a decade ago, you can see that this is like a fairy tale best case scenario. So don't expect this deficit to GDP to hit 6.1%. It's going to exceed that by a massive margin. And the only way that they're going to be able to finance the level of debt and borrowing that we are going to see over the next 10 years is to print massive sums of fiat currency. And again, there's a lot of manipulation going on right now, but I'm not talking about paper contracts being sold at the COMEX, right? What I'm talking about is manipulation of people's perceptions and what people understand about the economy. Because, go on the street and talk to your average person, okay? Look, if you talk to them about Bitcoin, they're going to know what you're talking about, right? If you talk to them about the U.S. debt crisis and the fact that we have over $200 trillion in unfunded liabilities and that we have a national debt which is growing at an absolute breakneck record pace. I mean, most people are going to have no idea what you're talking about. They'll say, oh, yeah, well, the debt's bad, but it's been bad forever. So, that can just go on indefinitely. Never mind the fact that you've got global de-dollarization. We're on the verge of a major global conflict, which is going to drive the debt to untold proportions. Talk to your average person about gold and silver. Talk to your average person on the street about the regional banking system. I mean, nobody is going to know what you're talking about. Maybe there are some informed individuals out there like yourselves, like myself to some extent, not tooting my own horn, but I think I am a lot more aware of these things than your average person, probably just because the bar is being set so low, because there is this concerted effort to control perceptions surrounding money printing, surrounding the dollar, surrounding the true nature of our debt-based economic system. But when that manipulation ends and when, the consequences of all of this money printing and all of this deficit spending and all this borrowing become impossible to ignore and impossible to spin, well, you're going to see the dynamics for the gold and silver market change. That I am pretty convinced of. Who knows? I don't have a crystal ball, but I don't see it going any other way than that. It's just my forecast. Let me know what you think in the comments down below. I mean, there's a lot of reasons right now why the Fed is going to have to print. There's going to be a lot of money printing that goes on before the election this year. That's my forecast. Let me know what you think in the comments down below. Stay safe and happy stacking, everybody.